A family trust can save you a lot of tax when you're investing. Basically, once you have a trust, you can open up investment accounts, bank accounts, and buy property. And when you do this, you don't personally own the investments. And that means that because you don't own the investments, the income from those investments isn't added to your personal taxable income and isn't taxed at personal marginal tax rate. So that's where the big tax savings come from. Now, one of the big rules of trust is that your income does need to be distributed to another tax-paying entity. But this is the beauty of a trust because you can spread the income out over multiple taxpayers, and that means that your tax ends up being a lot lower. So, like for example, if you make a $1 million gain on an investment property, if only one person is paying tax on that 1 million bucks, the tax is going to be around 440 grand. But paying the same $1 million in income across 5 taxpayers means only $300,000 in tax paid, meaning that you get $140,000 in tax savings. Setting up a trust does come with some costs, but it is pretty simple. And so if you want to do this, you basically just go to an accountant or lawyer and you set up what's called a trust deed. It's a super long document, pretty boring, basically just outlines the rules of the trust. Once you've signed that off, that you basically get a tax file number and an ABN, and then you can go start opening up bank accounts and investment accounts and even take out a mortgage. Now, because there is a cost that comes with setting up a trust, probably like a few grand to kick it off and maybe a couple of grand each year to manage your tax returns, you need to make sure that you're getting a benefit, a tax saving on top of the fees that you're paying. But like I just mentioned in that example, there are some serious tax savings up for grabs.